Hello, we are Water Street Advisors and we're pleased to be here today to present to you our recommendation on the Sequoia Development Project. Our comprehensive analysis has led us to the conclusion that this investment is unsuitable for ROAR, and we recommend that you ultimately choose not to invest. Although we recommend that you do not invest, this is our proposed financial metrics given an investment. So with an equity injection of $16.25 million, this would result in a profit of $8.79 million, a leveraged IRR of only 16.35%, and an equity multiple of 1.54. Our team projects that the timeline for this project would be 42 months, with the entire project completing 6 months before fund maturity. In terms of evaluating ROAR's fund objectives, this investment would not meet your preferable investment range of $20 to $50 million, as the capital deployment for the Sequoia would only amount to $16.25 million. Also, at this point in the fund's life cycle, with only 6 months remaining in the investment period, we recommend, because of the fact that this fund is expected to achieve a return that is quite superior, that you actually hedge your risk by taking on lower risk investments. Furthermore, when you compare this investment opportunity and benchmark it to comparable investments already contained within your fund, the leverage IRR of 16.35% for this project falls very far below 27.5% as the average comparable. And finally, we will explain that the expected returns of this project just do not compensate for the risks associated with it. So, this does not meet many of your fund objectives. As I mentioned, the risks exceed the expected returns. Our teams identified 3 major risk factors that make this deal unattractive: financing, sales and marketing, and the partner. So, due to the fact that this investment does not achieve many of your fund objectives, and the fact that the risks exceed the expected return, we ultimately recommend that you choose not to invest. In the next part of the presentation, we will outline, if you were to go and invest and develop on this site, the optimal use would be for luxury condos. Then, we will outline the major risks that are inherent in the deal itself. By doing this, we will explain the adjustments that need to be made to the developer's proposed plan in order to realistically project an expected return. And then finally, we will conclude with our recommendation that this investment is unsuitable for ROAR's Fund 7 at this time.
In this section, we're going to analyze the market, sub-market, and provide you with an analysis for the highest and best use for the site. So, Redwood City is located within San Francisco Bay Area. It is 25 miles away from 2 central hubs within the peninsula. Additionally, Redwood City is located about 5 miles away from Silicon Valley, which houses a lot of tech firms. Looking at the characteristics of the Redwood City, you can see that it is a tech-centric economy with a location quotient for the information and technology for industry above 2. Additionally, it is a suburban characteristic market. However, there's been recent revitalization plans to urban character market. Thirdly, there's currently a population of 20% population below age of 18, and that means there's a lot of families that will demand larger house sizes. Lastly, being in proximity of Silicon Valley, it means there might be possible demand by employees working in the valley that are willing to commute to this city and are demanding larger house sizes. So the project Sequoia, where is it? It is within downtown Redwood City, and you can see the images depicting the existing office structure. Next up, we're going to look at 3 possible uses for the project and conclude with luxury condominiums as our highest and best use.
So firstly, looking at office in Redwood City, we know that market reports have indicated that absorption of office space in Redwood City is usually by large transactions with a single tenant. However, we also know that tech companies are the only ones capable of leasing space higher than 70,000 square feet. So we see that there is a conflict between these ideal target tenants' needs and your site's offerings because it is in the downtown. Instead, tech companies would prefer to have more open space and the potential for views, thereby locating in Redwood Shores and its surrounding areas and its surrounding islands. Since it would be so difficult to attract these tech tenants to your Sequoia downtown site, we now move on to determine whether the best use is luxury apartments or luxury condominiums. In Redwood City, the percentage of units occupied by owners and the percentage of units occupied by renters is comparable. However, if we look at wealthier households, we see that the preference to own is much higher than the preference to rent. So if Sequoia is targeted at luxury price points, then it is better to target owners rather than renters. A rent versus buy analysis shows us that the difference in monthly housing costs is only 16%, with monthly ownership costs at approximately $4,800. Those households that earn greater than $200,000 can easily afford the monthly payments. Now, comparing the project metrics of the three uses, we see that luxury condominiums provide the highest sellable price per square foot, as well as non-residual, which means that it is the best use for this site. With Sequoia's luxury positioning, it can also target the following price points. On average, units will sell for $1.05 million, or approximately $682 per square foot. Nevertheless, we know that Redwood City is a relatively untested market for luxury condominiums. In order to truly determine the appetite for this product in the market, we assess the project's attractiveness from the perspective of a potential buyer. Although Redwood City has 13.2% of households with high incomes, we see that there is a much greater percentage of these wealthy households in surrounding cities such as Palo Alto and Los Altos. And because Redwood City is not highly differentiated from other Silicon Valley cities, we see that potential buyers would also be looking at housing offerings in these other markets. Substitutes can include single-family homes in Redwood City, condominiums in Redwood City, Palo Alto, or Los Altos. What is concerning to the project is that in these substitute markets, there are housing inventory available at price points that are below the Sequoia, thereby threatening the Sequoia's target market absorption.
In evaluating the development plan, we've identified three inherent risks. They fall in the financing, the sales and marketing plan, and the actual partner. And what we've come to conclude in this analysis is that ROAR would not be properly compensated for these risks in expected returns. In the next three stages, we're going to be showing you how the developer's case needs to be adjusted to reflect a more realistic case that has a lower return given these high risks. Starting with financing, we don't expect that the existing lender will want to deal on a luxury condo given the fact that they're underwriting for multifamily, and this is a very common concept in first position capital markets. These lenders have already only recently cleaned up their balance sheet from the issues they had during the recession, and they were looking more for properties that can attain pre-lease or even stable cash flows. On the other side of the spectrum would be going all equity on the deal. However, we suggest highly against that, given the fact that there's so much risk in dealing with a new partner and in a city that has never seen this product type before. As well, ROAR would not be able to take advantage of the leverage returns that it's become so accustomed to in being able to show its shareholders. Finally would be a plausible return, which would be the difference between the two, and that would be going with a more non-traditional first position lender. These are individuals who are normally partaking in mezzanine finance, who are willing to pick up the slack that would be present for a condo development such as this. However, it is going to come at a higher cost. In identifying the market research that we've been doing, we recognize that an interest rate between 10 to 15% with loans to cost between 50 and 90% are becoming the norm for these lenders. However, in our underwriting for our deal, we expect a 10% interest rate with a 50% loan to cost. We feel that the bottom section of both of those figures are adequate considering the fact that we'll be able to offer a first position and only take 50% LTC. And what we can see is the first commencement of actual lowered returns that would be available for ROAR, meaning that finance is simply just the first step into what risk you would be able to take on.
I will now be discussing how sales and marketing and your potential partnership with the developer will affect your overall IRR. First, luxury developments inherently are largely dependent on the ability to achieve your price projections. As you can see here, luxury condominiums in Redwood City are priced 73% above non-luxury condominiums. Given this large difference, we've evaluated price sensitivities over a range. Our base case assumes selling the condominiums at $682 per square foot, with a break even at $498. The most important thing to note here is that it only takes an 8% decrease in order to reduce the project IRR to the fund level requirement 15% IRR. Therefore, when looking at non-luxury condominiums at $393 per square foot, we believe that the success of the development is largely dependent on this luxury demand. Absorption is another key risk. Even in the market for ownership within the market, there's still competition. Single-family homes have far higher absorption rates as compared to condominiums. Therefore, there's a high absorption uncertainty when it comes to the luxury product. In addition, the developer has estimated lower per unit marketing costs than the other comparables provided in the case, and sales and marketing costs therefore need to be increased in order to meet these absorption goals. As you can see, your returns degrade further. I'll now be discussing the risks inherent in the developer. As you can see in the promote structure, Roar is in a relatively safe position. It receives 100% of its capital back in addition to a 10% preferred return before the developer receives anything. Despite the secure position, however, the Roar's IRR is limited to the project leverage IRR as the ceiling. The developer also has some inherent risks within himself, as a new partner with no pre-existing relationship with each other. He also has a lack of condominium experience, and in particular, zero experience when it comes to platform development, such as the Sequoia. He has also had a littered history of being on the verge of bankruptcy twice in the past decade. All of this, the developer risk and the cost uncertainty together, mean that an adjusted contingency of 7% is far more realistic. Therefore, as you can see, the developer has ignored these three blatant risks inherent with this project. Therefore, your project IRR has decreased from 26% to 21.1%, with Roar receiving a 16.4% leveraged return. We believe, however, that this is a far more realistic base case with which to start evaluating the project.
I'll now move on to how this project affects the overall fund. Beginning with the developer. This developer is motivated to complete this project. He's repeatedly made comments to the media and to the local community that he will stop at nothing in order to see this done. He continually calls it his crown jewel. And what this means is that the project conditions are such that the developer can neither be bought nor removed nor bought out. Furthermore, any capital will be fully committed to this developer's vision. And finally, the project completion will supersede the project's returns. I'll now go through how we analyzed this project's position within the fund. First, we looked at whether the fund was overperforming or underperforming, how much capital was remaining, and should there be any capital remaining, what was the best avenue to deploy it. What we note is that the current expected return on investments is 22.2%, well above the fund's target of 15%. Therefore, moving forward, the focus should be not on trying to receive excess returns, but on portfolio balance, Roar's reputation, and at the point in the fund's life cycle. Because the fund is overperforming, we then looked at how much capital was remaining. What we noticed is that there is $39 million in excess capital, which represents 8% of your total fund. We believe this is too much to return straight to investors, and therefore analyze two potential investment alternatives. This is an 8-year fund, with 6 months remaining in the investment period. You have 2 projects in the pipeline, both developments returning 23%. An investment in the Sequoia would pivot a focus from raising future capital and ending out the investment period to a more risky investment. Additionally, the development risk associated with the Sequoia is such that it is not compensated for the return of 16.4%, especially when compared against other core plus and value-add alternatives that are returning 12 to 15%. The overall impact on the fund would be an investment in the Sequoia would reduce the overall expected return by 20 basis points. These lower risk alternatives only decrease the fund by an additional 10 basis points. This spread isn't able to be justified given the variability in expected returns. What we recommend is that you make an investment in one of these core plus or value add investments. This will help build upon your existing positions within these current investments with a total investment of approximately $16 million. This represents 3.2% of the existing fund and will leave 4.6% of remaining capital. This equates to approximately $20 million, which could be deployed to a higher risk-adjusted return should one come up in the next 6 months. Overall, this reduces the total fund return to 21.9%. So what we note is that the fund is overperforming, there's capital remaining, and the best place to deploy this capital is in one of the core plus or value add alternatives. Finally, the Sequoia's project risk does not adequately compensate for the return. And additionally, it does not meet the fund's objectives. Therefore, we recommend you do not invest in the Sequoia. Thank you. I'd now like to move on, open the floor to any questions. Should you have any need for further information, we'd be happy to elaborate on any of the points above.
Okay, so questions questions?
Do you have a development budget?
Yes, we do.
We see it?
Yep.
Can you see?
Are we walking away?
So you paid last year $12 million.
Yes.
So what would have to change for you guys to change your no to a yes?
There's a number of things that would have to change. In terms of the project cost, we considered paying him less. However, based on our analysis, this reduction would have to come to $9.5 million, and his return is significantly degraded because of this. Additionally, the other element we looked at was changing the promote structure. However, given that our projections for what this fund is going to be returning are such that changing the promote structure is only a marginal increase in that overall return, given that the total project return doesn't adequately compensate for the risk that we see in the project. And so we really felt that by changing either how much you paid him or how those returns were distributed weren't adequate mitigation methods in order to make this deal go through.
So even if you paid him 9, it still wasn't enough to change it to a yes?
At $9.5 million, $9.5 million is that break even. That's the amount that we'd be willing to do the deal.
Did you guys look at an upside scenario? It seems like a lot of your assumptions, especially the financing at 50%, I imagine that has some, it works as a multifamily, so the 10% seems a little bit conservative to me. But on an upside, maybe you can get to the mid to high 20s. Did you guys look at that one?
Well, I can speak to some of the financing. When we did run multiple scenarios based on what we could get for apartment financing, using the lower rate that the capital market and the lenders would be willing to give us. However, even with the 10% hold, the 10% interest rate that the mezzanine or the non-traditional lender for the first position would be willing to take, we still came out better with using the 10% versus the 50%. The 10% interest rate versus the 50% loan to cost. Just because
you use a 10% interest rate at 50% loan to cost.
yes, and then the other reason behind that is that we see that this investment is actually such a low dollar value. You are already far off the actual regular deployment that we would really need at the 20 million. So it's just furthering that gap and making this less and less of a deal that we would want to see for a fund that's operating in a $500 million budget.
Being that you said your break even is 9.5, would you have recommended this deal if you would have taken $9 million or $8 million from the land?
Yes, the 9.5 is actually contingent on the ability to procure financing as well. There are a lot of other inherent risks.
Assuming you can get financing.
At the $9.5 million land value, if we recapped on that value instead, we would actually receive project IRR of 28%. So that would actually leave a lot more room in terms of negotiation for the promote structure. Because one of our main arguments was in the promote structure, you could only negotiate up to the project leverage IRR. So as soon as you bump that up, there's more room for negotiation.
So the deal, you would have made the
Yeah.
yes recommendation at
Yes,
9. or
contingent
9.5.
on financing, yeah.
What's the unleveraged IRR? I see like on page 2 or 3, the profit margin's about 50%, which is pretty healthy.
I think it's 37%.
Sorry, the unleveraged IRR on the development project?
Yeah.
It's 19.4%.
19% unleveraged IRR.
That's after we made our adjustments to compensate for some of those risks.
For the project.
For the project.
Sign me up.
Yeah, 19% on leverage, and higher than that leverage.
Yeah.
What is your margin on cost?
The return on cost is 37%. Return on cost is 37%. It's in the financial supplement as well. that we provide.
You're building for $494 a foot, you're selling for $679, is that right?
682.
You didn't
It's a
comment
clerical
on this
error.
plan. Are you guys comfortable with the plans that he's prepared for this, the development plan, the layouts, everything else about the real estate development?
Sorry, could you repeat the question?
You didn't comment on his layouts, his plans. Were you just assuming that those work? You like those plans?
Well, Sorry, I can comment on one aspect of the proposed budget given by the developer in conjunction with this GC. We feel that those comparables that they used were fairly inaccurate due to the risk involved in this project. That's one of our major reasons we moved the 1.7% contingency on hard costs, took that out, and applied a 7% contingency on both hard and soft, due to the fact that this developer has never taken on platform projects before, and most of his experience is actually in office and in single-family homes. So we thought that the comparables that was provided were actually fairly unusable, so that's one element of something he changed, and that was reflected in the new returns.
But did you agree with the unit mix, the unit size?
Speaking from a electric condo point of view, the unit size what we felt was fair, given that was the target he was trying to, that was the demographic he was trying to target. Should that use change to apartments, that obviously that unit mix would then be inadequate.
You guys did a really, really good job on the market research and the demographics and the income and all of that. My concern is that you did that after you already made your decision to say no, because, well, you know, statistics and data is an art as well as a science, right? And just depending on how you say it, it could sound different. It could sound like a positive or a negative. The demographics started out sounding really good. You have, you know, a nice percentage with high median incomes, with higher incomes. I'm sorry, but then you go and compare it to Palo Alto and Los Altos, and now all of a sudden it looks terrible. But there's still growth in that market. There's still growth in those number of households. So I'm not sure that you should have negated that so quickly and have seen that as a negative. You know, you don't have to take everything as a negative, even if your final answer is no. I'm sorry. Just one question. So how many units have you sold when you finished construction?
There was no pre-leasing. There's no pre-sales.
Yeah, so in the end, it would be with his original plan of 48 units.
But
Luxury
you had
units.
nothing sold by the time you finished construction?
Oh, no.
Okay.
Okay, no more questions.